I almost never have cash on me, just my credit cards. And I pay my friends, my bills, all using this. This has honestly changed the world and how money moves through the economy. An estimated 149 million Americans, or 62% of smartphone users, use peer-to-peer payment services. That's up from 90 million people in 2019. Stocks of payment services like PayPal, which owns Venmo, and Block, which owns Cash App, boomed in 2020 as more people began sending money digitally. And then there's Zelle, which launched in 2017 and is owned by 7 big banks. It stands out from competitors in one major way. It doesn't have an independent revenue stream.
Zelle is a consortium of banks working together for an opportunity as opposed to a standalone company.
The financial institutions that were offering P2P services, many of them got together and decided that they needed a common branding.
But customers using any P2P service are vulnerable to being scammed.
What are the costs to consumers when things don't go well in the payment space?
You built the system, you profit from every transaction on the system, and you tell people that it is safe. But when someone is defrauded, you claim that's the customer's problem.
So why did the banks create Zelle? And what can be done to stop fraud on the platform? Zelle was launched in early 2017. It's owned and operated by Early Warning Services, LLC. That company is co-owned by 7 major banks: Bank of America, Truist, Capital One, JP Morgan Chase, PNC Bank, US Bank, and Wells Fargo. There are more than 1,800 banks and credit unions participating in the Zelle network.
Zelle is a P2P payment system that enables 2 people with different bank accounts to send money across from one bank account to another bank account instantly. They're trying to create the ease of money transmission that Cash App and PayPal and Venmo have, but while doing it in a contained ecosystem inside the bank.
And the banks needed a service that anyone could use because you, your mom, your best friend could all sign up for Venmo or for Cash App or for PayPal and send money to each other, whereas you might not be able to do that directly from your bank account. The banks didn't want to lose that engagement, so they said, we're going to build a service that's open to everyone.
Projections suggest that Zelle outperformed Venmo, PayPal, and Cash App in transaction value in 2022. The thing about Zelle is the banks don't really need it to be profitable.
You should think of this really as a little bit of an accommodation, but also as an engagement tool versus a revenue-generating machine.
Peer-to-peer payment apps can be traced back to the late 90s with the founding of PayPal.
Back when eBay was a baby, basically. It was a wonderful invention that kind of occurred right after Y2K. So it facilitated transactions between people who didn't know each other, particularly in this online auction space. And at that time, we were still using checks for those types of transactions. That's what person-to-person payments stepped in to address. And PayPal was the person-to-person payment provider that stepped in to do that.
Several banks tried to compete with PayPal back in the early 2000s, but they ultimately were forced to shut down. One of their major flaws was trying to monetize their services when PayPal was not only free, but also paying people to join and to refer friends.
I think the failure in the past was that they were trying to emulate PayPal without really understanding what was going on. They were trying to monetize something that was already being given away for free. So they have learned that lesson, obviously, because Zelle is a free P2P mechanism.
The other thing that led to the banks pulling out of P2P payments was the high rate of fraudulent activity.
With the beginning of any new product or services, there's fraud and there's gaming, and it's how quickly you can learn and consume that to make the product better. It has a real impact on how well the service is able to survive. And admittedly, financial institution tolerance for stuff like that is pretty low, whereas, a fintech might be more willing to have some losses and learn as they go.
Venmo was founded in 2009. It was purchased by PayPal in 2013 and grew in popularity a few years later. Similarly, Cash App was launched in 2013.
For banks, it's a no-brainer to try to compete in that space. Customers use their mobile banking apps all the time, and no one wants to cede opportunity from a space that people are already really active in to third-party competitors. So that's where Zelle kind of came into the picture.
So Venmo is actually pretty different from Zelle. On its face, it's also an account-to-account fintech challenger, but there's a number of different ways in which Venmo can monetize its consumer base that Zelle does not take advantage of. For a variety of reasons.
Venmo has the most users, but a lower volume that leads to a lower average transaction value. And Zelle, on the other hand, has a really high average transaction value. That's because it's really popular for high value transactions. For example, I use Venmo a lot for social, but I also pay my rent on Zelle. And that dichotomy is super common, and it makes competition in the space really interesting because it isn't necessarily a quote unquote winnable space. It's a space where providers can compete for volume, but they can compete for different kinds of volume, and you can get users who are on another platform to use yours, even if they don't give up the one that they were using before.
Tight security can be at odds with convenience, and that also applies to P2P payment apps. Of the 7 banks that own Zelle, 4 of them reported more than $90 million in scam or fraud claims in 2020. That number jumped to nearly $236 million in 2021. An October 2022 Senate report projects it will exceed $255 million in 2022. The report also says that in most cases, the banks are not repaying customers who were the victims of a fraud or a scam.
You built the system, you profit from every transaction on the system, and you tell people that it is safe. But when someone is defrauded, you claim that's the customer's problem.
Senator Warren has also accused the consortium of banks that own Zelle of withholding information about these scams and fraud cases. Zelle's parent company, Early Warning Services, LLC, called the report, quote, misleading in an October 2022 press release. Zelle says that more than 99.9% of payments are sent without any report of fraud or scams. There have also been reports of fraudulent activity on PayPal, Venmo, and Cash App. All 4 companies provide resources to consumers to better protect themselves.
One of the reasons that P2P fraud is so tricky is because it's less about something that's inherent to the platforms. It's not like they're being hacked or there's data sort of falling off the edges or whatnot. And it's more about human error. People are being tricked online, there's social engineering, there's scams, and they're falling for it.
Companies like Zelle and others will say, well, the consumer has to work with their financial institution. We're not the bank, right? And I think that just puts too much onus on the consumer. Right now, the way that things are in terms of legal liabilities and responsibility, companies have obligations to investigate and to adhere to certain prescriptions, but the consumers largely still can be liable for sometimes up to $500. So that's problematic.
Most of them are taking it on a case-by-case basis. So they'll listen to what the situation was and then make a determination about whether or not those are funds that should be returned to the consumer. And there are times, too, where they will work with the receiving bank and try to claw back those funds. That doesn't always work because if the funds are already taken out of the account, what are you going to do?
The challenge is that once you're online, there's like continually evolving kinds of schemes. And yet, I would say with respect to all of the companies, not just Zelle, beyond education, you don't really see the technology keeping a pace with methods that consumers can use, A, to either slow down the transaction, and you do see companies responding there, or B, if we're in a real-time payments and transactions space, are there real-time solutions to managing and preventing fraud? And who should bear the responsibility?
There's some mitigations around that, about like how much money you can send at one time. But fraudsters are creative. So I think what we'll need to see, and what I expect to see in some form or fashion, is some ability to rein in and provide some consumer guarantees around reversibility or effectively a chargeback.
They are working to fix the fraud problem, and there's really 3 approaches they're taking to that. The first is a tech-driven approach. They basically use AI, machine learning, to better make sure that senders and recipients are who they say they are on the back end. There are also education campaigns. When you're sending money, you might get a prompt saying, are you sure you're sending this to who you think you're sending this to? Just to try to preempt the fraud before it happens by making consumers more aware that it's a risk. And then the third is this rumored reimbursement plan that came out late last year. Under this plan, banks would determine if a fraud claim was legitimate, and then the bank that holds the account where the funds were sent would reimburse the victim. So if I sent money to you and you were a scammer, your bank would be responsible for paying me back if it was proven to be a claim that could be repaid. Competition in the space is really fierce, but it's complicated because it's really common for people to use multiple apps for different use cases. So I would say that the majority of P2P users are on more than one of these platforms and potentially even all four of them, but they are using them in different ways.
The companies are competing to gain more share of users in different age demographics. Only 20% of people over the age of 65 said they use Zelle, while 41% said they use PayPal, according to a Pew Research Center survey from July 2022.
What we're looking to see is more people who are older, who have greater financial means, higher incomes, starting to adopt fintechs as their primary mode of accessing financial services.
Gen Z and even Gen Alpha, like, are digital everything all the time. They live and die by their smartphones. Everyone wants to reach this population. Cash App already launched a teen account. Venmo seems to be exploring it this year. It's an exciting opportunity for growth potential because if you can get people when they're really young, they might form habits around you that last for a lifetime.
The branding is helpful in that, you aren't looking at Wells' individual P2P payment mechanism or Citi's individual payment mechanism. It looks very cohesive across the financial institution landscape that's participating in the network. So I think all of those things bode well.
They're trying to chip away at some of the frequent challenging points of interacting with the banking industry, whereas Cash App, PayPal, and Venmo are really growing off a viral P2P benefit.
Providers are trying to get new features out there. I'm interested to see how they're looking to tighten relationships, grow their volume through these new offerings.